I think we can officially start our session for today. First of all, good afternoon, everyone, and a warm welcome to today's webinar on unlocking capital markets through credit ratings, jointly organized by ICRA Rating Agency Limited and Capital Market Association of Zambia, or CMA Zambia. Again, my name is Javella Makalalad, and I'll be your moderator for the next 2 hours. It's truly a pleasure to have such a distinguished group of participants who is joining us today, from regulators to market operators, financial institutions, corporate leaders, and to development partners, all united by our shared commitment to advancing Zambia's capital market. Before we begin, a few quick housekeeping rules or notes. So this session is being held virtually via Zoom and will run for almost 2 hours. Please ensure as well your microphones is muted when you're not speaking. And you may post your questions in the Q&A section at any time, so we will address them during our interactive discussion. So we give priority on the questions that will be posted on the chat. So let's begin the session by inviting our ICRA Director and Head of our Africa Operations, Mr. David Mambasi, to deliver the official welcome and opening remarks. Mr. Mambasi?
Hello, thank you so much, Vella. And to everybody, good afternoon, ladies and gentlemen. On behalf of the International Rating Agency, ICRA, and indeed on behalf of our esteemed partners, it is my pleasure to welcome you to today's webinar, Unlocking Capital Markets Through Credit Ratings. We are honored by your presence and truly appreciate you taking time to be with us today. As global financial markets continue to evolve, the importance of credit ratings in providing clarity, credibility, and confidence to investors, regulators, and stakeholders cannot be overrated. Our agency is committed to contributing to this effort, and we have since published 8 rating reports for 8 listed companies. We plan to cover all remaining entities by the end of this year. Today's webinar aims to educate market players on behalf of, today's webinar aims to educate market players on the benefits of credit ratings and how they can positively impact the market. We are privileged to have an expert of panel speakers who share their insights and knowledge. To our attendees, your participation demonstrates your commitment to professional growth, industry development, and knowledge exchange. I encourage you all to engage actively through the session, ask your questions, share your perspectives, and let's engage. Once again, thank you for being here, and let's have a productive and engaging discussion. Thank you. Back to you, Vella.
Thank you. Thank you, David, for that, for setting the stage with such compelling vision. So your remarks highlight not only the importance of credit ratings in unlocking capital market potential, but also the role of collaboration between regulators, market participants, and service providers like ICRA in building a stronger financial ecosystem. So it's a powerful reminder that advancing our capital markets is truly a shared responsibility. So our first presentation will set the stage by outlining the fundamentals of credit ratings and why they matter for Zambia's economic and financial development. So please welcome our representative from the Ministry of Finance and Planning, Zambia, Mr. Joseph Chifolo, to share his insights about credit ratings and its value to the financial ecosystem. Mr. Chifolo?
Good afternoon, everyone, and apologies for the technical challenges. Thank you. For Zambia and for the Ministry of Finance, ratings have been recognized as a very important tool for investors and market participants when assessing in terms of that taking capital or providing capital to sovereigns and also to firms. We have seen that Africa needs sustainable finance to basically achieve its socio-economic objectives of developing its country and the continent. And one key determinant of accessing affordable long-term finance from our perspective is ratings. Ratings basically have been backed in the risk profile for Zambia and for many other states. So for Zambia, we entered or we basically got our first rating when we wanted and planned to enter the bond market in 2011. And so far, our experiences have been quite interesting, and it's a lesson point for ourselves and also for other peer countries who plan to raise financing from the bond and capital markets. So Zambia was rated B plus in 2011, and we had such a rating until 2019 when we were downgraded to triple C plus. And basically what came out was in 2019, Zambia's public debt at the time was elevated, and our debt to GDP ratio obligations also increased rapidly. Now, as we stand, we are basically at the cusp or in the final touches of completing our debt restructuring process. And the expectation is that once we complete our debt restructuring this year, in 2025, Zambia will see an upgrade both on our foreign currency issuer and also on our domestic currency issuer for the long term. And then at present, we still have a stable outlook from the big three international rating agencies. So again, that is quite important for us because we have seen how the ratings have affected the cost of capital, not only for ourselves, but for entities and firms that are located in Zambia. And it is our desire that as we continue on the path of basically fiscal discipline and prudent management of the economy, one of the things we look forward to is completing our debt restructuring process, get ourselves a better rating, and also in return allow for domestic and foreign firms and organizations to raise locally here capital from the capital markets at lower interest rates. So from the Ministry of Finance and for Zambia's perspective, we cannot overemphasize the importance of ratings and how on the sovereign and corporates should adequately prepare for a sovereign rating or for a corporate rating. And we are quite delighted to be part of this forum, just to share a little bit of our experiences and also learn one or two things from our colleagues and delegates on this webinar. Thank you.
Thank you, Mr. Trifolo, for that very insightful opening into the fundamentals of credit ratings. You have set the tone of our discussion by linking these ratings to Zambia's broader financial ecosystem. So it's also good that you mentioned the rating given to Zambia, and very good point as well that the country needs to consider on how we can improve it as well. It's clear that understanding and applying credit ratings effectively can shape policy decisions and strengthen financial governance, as well as ultimately can drive capital market growth. Next, we will hear the regulatory perspective on credit ratings in Zambia, a crucial lens in, understanding the framework that ensures trust, transparency, and also market stability. So please join me in welcoming our representative and the manager market supervision from the Securities and Exchange of Commission in Zambia, Mrs. Gertrude Buyengwe. Mrs. Buyengwe?
Good afternoon.
Good afternoon.
And I'm glad to be here today. Just to reintroduce myself, my name is Gertrude Wuyungwe, and I am from the Securities and Exchange Commission, Manager Market Supervision. To speak to the regulatory perspective on credit rating agencies, I'll just quickly share with you a presentation. I'll just put it up for you just now. I hope you can see that.
Yes, it's clear. Thank you.
Okay. So I'll start with sharing with you a snapshot of what the capital market looks like and how much is being mobilized at the moment. So these figures are as of June 2025. And when you look at the equities market, the market capitalization is around 296 billion kwacha. And the Lusaka All-Share Index is over 20,000 points. We have 45 issuers of securities, and of those, 21 are listed on the Securities and Exchange, the Lusaka Securities and Exchange. And then we also have the collective investment schemes with over 3 billion kwacha of assets under management. And when you look at the government bonds, we're sitting at a market capitalization of over 180 million kwacha. And corporate bonds have a market capitalization of over 4 billion kwacha. And when we look at the green bonds, we have over 150 million kwacha. And overall, we have over 1 million investors that have invested in the different types of products that you find in capital markets. And I also just wanted to share with you the type of entities and players that you find in capital markets. So here I just have the various players from the dealers and investment advisors, share transfer agents, the various issuers, whether they're listed or corporate bond issuers. And then we also have other funds that we authorize and different other entities. And there in red, seconded red, I have the credit rating agencies because that's our focus for today. And from our perspective, the importance of having credit rating agencies is because we believe the ratings that are then provided are an essential tool that the investors that we are mandated to protect can use to assess the risks that are associated with the various issuers or entities that are rated. We believe that credit rating agencies are supposed to provide independent evaluation of the entities or countries that are being rated for investors to be able to make informed decisions. And overall, this is supposed to then help facilitate the flow of capital from those that have excess and those that actually need them. And we regulate the rating agencies because we are mandated to protect the investors. So if we regulate these entities that are providing these ratings and providing this tool that help investors make decisions, we are then able to appropriately protect the investors. And we believe that ratings enable transparency and accountability from the rated entities to the various investors. And then overall, we believe that level playing field is kind of provided because information is provided to everybody that needs to use the information. And overall, we reduce information asymmetry. So when we come to the authority from which we draw our mandate from, which is the Securities Act, we use Section 48 and Section 60 to really get the rating agencies licensed, and then we supervise them just to ensure that investors are protected at the end of the day. So the commission is credit rating agencies. We have various organizational requirements, and overall we allow for the quality and integrity of these rating agencies to be of high standard. So Section 48 is the one that allows us to license any credit rating agency or any person that actually intends to establish and operate a rating agency in the country. And then Section 60 of the Securities Act allows us to authorize any foreign-based credit rating agency. So for any foreign credit rating agency to be able to rate an entity in Zambia, they then have to be authorized to do that with the commission. We also are a member of the International Organization of Securities Commission. This is a global entity that we belong to, and so all other securities commissions, regardless of whether they are Securities Commission or Capital Markets Authority, whatever name is given to the regulator of securities in any jurisdiction, belongs to this organization. And this allows us to then use set and agreed upon policies or standards to be able to regulate the various entities of which credit rating agencies are amongst. So with these standards, we're able to ensure that the quality and integrity of the rating process is according to global standards, and that we also look at whether there is issues of independence or conflict of interest between the rating agencies and the entities that are being rated. Also, transparency and timelines of rating disclosures is up to global standards. It also helps us to ensure that confidential information is kept confidential, and what is then publicized is information that's necessary for the general public. So for us as Securities and Exchange Commission, we developed a national policy or a national document that we call the Capital Markets Master Plan, which is a blueprint for the capital markets, detailing steps that we need to take to be able to get to the desired position that we have. And amongst the 5 pillars of which details what these steps are, we have one topical one, which is enhancing capital markets regulatory environment. Under this pillar, we identified that we needed to ensure that we enhance the regulatory environment around credit rating agencies as well. And so that's how we've made some progress towards that. And you noticed that over the years, we didn't have any licensed credit rating agency, and now we have two licensed credit rating agencies. We had one for a few years, and now we have two that we have licensed, and ICRA is one of those. And even this platform where we're able to share the progress that's being made and to a large extent build some capacity in the market on credit rating agencies is one of the steps that we believe is to be taken in order to develop this sector as well. So for the commission, the way forward is for us to really implement the capital markets master plan. And I'll use this opportunity just to invite everyone that can be a part of this movement to share and join the working groups or action teams and ensure that we can learn from you or that your ideas can be brought to the table to enable us develop this sector. And also we want to enhance the credit rating regulatory landscape, which, like I mentioned, has to do with enhancing the regulatory framework that is specific for credit rating agencies and building capacity, not just for the rating agencies, but everybody, the entire ecosystem, the investors, the issuers themselves, even the government. And also just to encourage uptake on credit rating agencies, especially from the investors themselves, the users of these ratings that are provided by these agencies. So that's all I had for you today. If there are any questions, I don't know if I can take them now. Moderator, I'll
Yes,
leave that up to
for the
you.
questions, the participant can post it on our chat and then we will address it later.
Okay, thank you.
Thank you. Thank you, Ms. Gertrude, for sharing with us this year's market snapshot as well and sharing the regulatory perspective and how credit rating is, very important to consider in giving an edge in each and that entities. And also, thank you for guiding us through as well on the capital markets master plan in enhancing the regulatory framework. Definitely, your points underscore the vital role of a strong and transparent framework in ensuring market stability. It is also very evident that when regulation and market development move hand in hand, confidence among both local and also international investors grows significantly. Again, thank you once again. Now, we can turn to the Capital Market Association of Zambia, who will explain how credit ratings enhance market efficiency by improving transparency and also boosting investor confidence. Please welcome our representative and the Vice President of the Association of CMA Zambia, Mr. Matimba Chambua. Mr. Chambua?
Good morning, or is it good afternoon, depending
Afternoon
on
with us as
the
well. Thank you.
various the various time zones. Let me just switch on my video. So,
Thank you.
hello once again. My name's Matimba Chambwa. It's a pleasure to meet with you, and I will run us through a brief presentation on the Capital Markets Association of Zambia and what our role will be with regards to this credit rating. Just kindly allow me to share my screen.
Yes, please. Thank you.
And kindly confirm my screen is visible.
Yes, it is. Thank you.
Okay. Thank you once again. As mentioned earlier, my name is Martin Bachambwa. I'm the Vice President of the Capital Markets Association of Zambia. And just to give a brief on what our role is as CIMAS, our mission is to foster vibrant, transparent, and efficient capital markets in Zambia. And we believe that this discussion on the credit rating could not come at a more timely interval, especially given the evolving dynamics in our financial sector and the need to unlock the capital flows for sustainable growth. And today's discussion is very, very essential as it will give us more insight on how more ICRA can work hand in hand together with the Capital Markets Association of Zambia so as to drive this agenda. When we look at credit ratings, we would say from our point of view that credit rating can be seen as an independent opinion on the ability and the willingness of an entity to meet its financial obligations. So it's very, very important to have an entity assessed because we're dealing with people's money at the end of the day. So people will come in and speak very good English, come with very good figures, but at the end of the day, to have a credit rating from someone, from a trusted entity, will be very, very essential. Some people are blessed in different fields. So you could have personnel who are more onto, let's say, a farmer who has all this background or any type of aspect, but their credit rating aspects or their financial background may not be the strongest. So that's where this credit rating partnership or credit rating initiative will definitely come into handy. And it's also important that the credit rating is done by an independent an independent an independent third party, so to speak, that does not have any hidden agendas, that is not getting any commissions or any kickbacks, and also an independent party that has history of running through credit worthiness and is able and has shown that they do know what they are doing on the market. And lastly, this is extremely relevant to the users and even the regulators. Gertrude has covered most of it. Gertrude, Gertrude, my regulator, who just spoke from the Securities and Exchange Commission. So it is also important for the regulators. So in this slide, we'll just look at exactly how will credit rating improve transparency. As I have been mentioning through and through, transparency is at the heart of efficient capital markets. It's always good to know how the transaction has flowed. It also creates more efficiency in the sense that on the next transaction, someone will make it out of good faith. And also, if they were reluctant on how much they would like to participate in, with additional transparency, they will be able to stake more into the game. And credit rating is quite complex, as I mentioned in the previous slide. So that's why it's best to leave it to those who have the clear data. They have more than enough data as well and also they have the comparables. So what are we comparing this sort of variance with the comparable variance? And it does help essentially in the decision-making process and market participation. Now, coming to one of the key aspects that were here is that what is the impact on credit rating on investor confidence? When investors truly trust the quality of information they receive, they will be more confident in making commitments. Credit ratings offer that trust anchor, and there is no doubt about that. I'll give one example. Let's say a rated corporate bond can attract a broader investor base, and this could be pension funds, it could be insurance companies, even individual and international investors, simply because it is perceived as, pardon me, simply because it is perceived to have less risk, and it has been clearly quantified. And on the risk aspects, I will just touch on there's the whole issue of risk versus return. So if two corporate bonds, for example, have been rated and there are different risk levels, we do anticipate that the one with the higher risk will have a foreseeable higher return. So it just does help investors in our capital markets just look at the various nitty-gritties and also look at the credit ratings and see which type of corporate bond that they will be able to go for. A corporate bond was just one of the examples that I did use, but credit ratings span across various players/instruments in the capital markets. Now, speaking to enhancing capital market efficiency, an efficient capital market, we feel, is one where the prices reflect all available information, transactions occur at fair value, and capital flows to the most productive users. So when transactions occur at fair value, we all know what we are getting, and there are no hidden agendas, and you will not be overpriced for one aspect, or you will not use other means to underscore what you are purchasing. We feel that credit ratings contribute to this by aligning the cost of borrowing more closely with the true risk. So when you are borrowing or lending out money and the person is perceived as more risky, obviously there will be a higher premium. So with the credit rating, even that premium will be standardized. And looking at this in the Zambian context, our capital market is still relatively small compared to our regional peers, though we are growing at quite an impressive rate. Credit ratings, when widely adopted, can deepen the capital market by making more instruments investable, especially for regulated institutional investors. And our role as CIMAS Capital Markets Association of Zambia is committed to collaborating with rating agencies, issuers, and regulators to mainstream this practice. Looking at our partnership opportunities between CIMAS and ICRA, our partnership between associations like yours and our partnership between associations like ours and rating agencies like ICRA are 100% essential. Together, we can increase awareness, build issuer capacity, and advocate for regulatory frameworks that reward transparency and ratings adoption. With all this being said, we need to have a core of action, and we believe that the time to act is now. And this is a great opportunity to unlock Zambia's capital market potential. We must make credit ratings a standard practice and not an afterthought. Call to action is now, and we believe that if we work together as issuers, investors, regulators, and associations, we can make this a great, great reality. In closing, I thank ICRA for creating this platform, and I look forward to continued dialogue and collaboration to build a stronger, more transparent, and efficient capital market in Zambia. Thank you for that opportunity. I will take any questions if present.
The questions, Mr. Chambo, will have it later at the end of the latter part of our session for today.
Okay,
But
okay.
yes,
No
thank you so much, Mr. Chambo, for that very valuable perspective that you have shared with us. It is truly inspiring to see how associations such as CMA Zambia are taking a proactive role in fostering transparency, strengthening governance standards, and also building a more resilient capital market environment. Definitely, your remarks highlight that credit ratings are far more than a numerical assessment. They represent a shared language of trust, credibility between issuers, investors, regulators, and the wider market community. So, by promoting this trust as well, we not only attract and retain investment, but also lay the groundwork for sustainable growth, deeper market participation, and stronger alignment between Zambia's capital markets and global best practices. Again, thank you so much for that, Mr. Chambua.
Once again, thank you for
next-
the opportunity.
You're welcome, sir. Our next speaker will explore how credit ratings are important and how it can enhance investor confidence from the perspective of Lusaka Securities and Exchange. So please welcome our Chief Financial Officer, Mr. Crispin. Mr. Crispin, if you are on already in, kindly raise your hand. I think he is there with us.
Thank you very much.
Hi,
Yes,
there.
actually, I'm in.
Thank you.
Thank you so much. In representing my CEO, Mr. Nicholas Cavoso, I'll do the presentation for Luce. As you've already indicated, my name is Crispin Hatimba, and I'm the CEO for the exchange. Allow me to present my screen, to be my screen. Tell me if you're able to see it.
Let's wait. We're not seeing it yet.
Okay. Not yet?
Not yet, sir.
Okay.
There you go. I think wherever.
Is it visible?
Now it is. Yes. Thank you.
Okay. All right. Perfect. All right. Thank you very much. Like I've indicated, my name is Crispin Hatimba, and I'm the CFO at the Lusaka Securities Exchange. I'm going to do this presentation on behalf of my CEO, Mr. Nicholas Cavaso. Obviously, our topic is about enhancing investor confidence through credit ratings. So I think in terms of the definition of credit rating has already been given. I think the other speakers have spoken very well, clearly. Credit ratings basically is an independent assessment of the credit worthiness of a borrower, whether a company, a government, or a financial institution. They provide basically a standardized signal of financial health, repayment capacity, and also the default rate. So for investors, ratings reduce the information asymmetry, as already been, described, helping them to, make faster, smarter decisions. And in terms of the credit rating and also investor confidence. So obviously, credit rating plays a very critical role in this. Firstly, they provide transparency. Investors gain a clear picture of potential risks, which obviously assures them about the safety of their investments. Secondly, ratings act as a market signals. A high rating obviously communicates a strong financial health. A low rating obviously serves as an early warning. And thirdly, they reduce uncertainty, and especially in markets where financial disclosures may be limited or uneven. And also, they provide some kind of a benchmarking. They enable benchmarking to allow investors to compare opportunities across markets, sectors, and also, financial instruments. Now, in terms of the benefits to the issuers, there are quite a number of benefits. We've got lower cost of capital, broader investor base, enhanced market visibility. A strong rating can lower the cost of capital since the lenders obviously demand, smaller risk premiums. It can also attract a broader investor base, especially for financial institutions. Financial investors such as the pension funds, who often may have, mandates to invest in high-rated instruments. And also it enhances the market visibility, like I've indicated, which obviously signals the credibility of both the local and also international investors. And especially for international investors, obviously it becomes very critical for them to, kind of invest in instruments, obviously, that are, that are rated, because that gives them comfort. In terms of the role of rating agencies, a strong rating, global agencies such as ICRA and Moody's, S&P, and also Fitch, along with other regional and domestic agencies, provide the analytical expertise that may be needed for credit assessments. The independence and also objectivity of these agencies is really critical, as investors may want to trust, the investors' trust, depends on their perceived credibility. So that then becomes very, very critical. And then in terms of the challenges and limitations that obviously investors may have with regards to credit ratings, investors sometimes rely on ratings, treating them as guarantees rather than opinions. Agencies also can react slowly, to emerging risks, and also the issuer pay model may raise questions, about independency, and also ratings can be misinterpreted sometimes, And sometimes these misinterpretation may downgrade, and also even causing panic in the market. And then in terms of the strategies to boost confidence, we've got quite a number of them. Obviously, there's transparency in the methodology. You've got regular updates that is needed, complementary disclosures, and also investor education, as well as local and global accreditation. So investors sometimes, transparency is really key in explaining the rating criteria, for trust to be built. Ratings should also be updated regularly, to reflect current risks, and also issuers should complement ratings with robust financial reporting, and also investors should be educated on how to interpret these ratings. For emerging markets, for example, signaling, aligning with international standards can also enhance credibility. So what we're saying is that, look, I think it's also very, very important for companies, institutions also to make sure that their reporting, is quite credible, and they follow the financial reporting standards, and also even just the corporate governance, and other controls should be sound, to enhance, credibility. In terms of some examples in this regard, we have emerging market bond issuers often see higher invest uptake when they are rated. When bond issuers, are rated, obviously you see a lot of uptake from the investors, because obviously investors will be attracted to invest in such kind of bonds. And also when it comes to SME listings, domestic ratings increase institutional participation, which is very, very true, because, SME listing that obtain a domestic credit rating may experience increased institutional participation. Everyone will see that, SME as very credible, and obviously, even in terms of the risks, they're perceived to be quite low. And also post-downgrade recovery, governance may improve to restore, trust. This is very, very important because, if a firm that has or is trying to improve its governance after downgrade may regain, higher ratings, after once all these mechanisms, the controls, the governance are put in place, that can obviously help them to change, the rating if initially they were downgraded. So in conclusion, ratings are really vital, in trusting tools. In trust building tools. When credible and updated, these reduce uncertainty, widen investor base, and also lower the cost of capital. And they must be also paired with strong and governance disclosure. So it's very, very critical that companies, institutions, put in place very strong control mechanisms. They improve their governance, and also just to make sure that they kind of update. They improve in terms of the financial reporting standards. Financial reporting adherence, just to improve their controls. These are some of the things, obviously, that can kind of help them to improve the credit ratings. This marks, the end of my presentation. Thank you very much.
Thank you. Thank you, Mr. Crispin, for sharing those insightful perspectives with us. Your points reinforce the fact that, credibility is one of the most valuable currencies in today's capital markets. It is the foundation of which trust, investor confidence, and long-term market stability are built. So by highlighting how robust credit ratings serve as an independent and transparent measure of that credibility, you've drawn a very clear link between strong creditworthiness and market stability to attract both domestic and also international capital. So this is not only fuel trading activity and market vibrancy, but also encourages deeper investor participation, greater access to funding for business, and stronger integration of Zambia's capital markets into the global financial system. Thank you once again, Mr. Crispin.
Thank you very much. I appreciate.
You're welcome. Our next speaker looks at the impact of credit ratings on domestic investment, presented by the representative and also the portfolio manager from the Workers' Compensation Fund Control Board, or WCFCB, Mr. Arnold Kakunta. Mr. Kakunta?
Yeah, thank you very much. Great to be here, and we are very pleased to have been invited to participate in these particular interactions on the roles of the capital, the credit ratings in capital markets. Allow me to just share my screen. Is my screen visible?
Yes, it is. Thank you.
Yeah, thank you. So I'm going to speak to you on the impacts of domestic ratings on investments. And very briefly, I would like to just share with everyone what we do as Workers' Compensation. So Workers' Compensation is a statutory organization established under Act number 10 of 1999 of the laws of Zambia. And our mandate is to be able to provide compensation benefits to victims of accidents and those that are disabled in the course of their duty. the objective that we have is to be able to administer a compensation fund out of which workers that are disabled or injured during the course of employment are compensated from. In terms of the asset classes that we are permitted to invest in, those are the asset classes that we have. They include property, listed equity, unlisted equity, government securities, corporate debt instruments, term deposits, collective investment schemes, cash, and also some forestry plantation, as well as public-private partnerships. So credit ratings and their effect on domestic investments. So from what we think as workers' compensation, in terms of credit ratings, we think credit ratings are critical because they will enhance due diligence across all the asset classes. If you noticed the presentation, the slide before this one, at workers' compensation, we have our assets that span across the different asset classes, the government bonds, corporate debts, financial institutions, listed and unlisted private equity instruments. So by relying on a local credit agency like ICRA, which understands the Zambia's regulatory and economic context, will be better equipped to quantify risk and enhance our due diligence, especially in areas where market data is very limited. You may wish to note that sometimes in a small market like Zambia, market information is very limited, and we will rely on players such as yourselves to be able to help us be able to quantify the risks. Then the second one that we are looking at, it will assist us to be able to strengthen risk-based asset allocation. As a pension fund, our investment strategy must be balanced between returns with stability and also regulatory compliance. We have a lot of regulations within the acts that I referred to that we as an institution will have to adhere to. So that in itself will just not run into the returns, but we'll be able to also be able to know that we are within the various regulatory checks that we are supposed to deal with. It will also help us segment the investment opportunities by risk tiers. It will assist us to allocate the credit worthiness of those benchmarks that we set for ourselves. And also, if we are going to tell ourselves as an institution to say, if the minimum benchmark that we have set for ourselves is a BBB rating for corporate bonds, we will assign higher premiums and lower premiums to those that are rated according to the risk profiles that has been assigned. That is how we think credit ratings agencies can assist. In terms of the support for market development through transparency, workers' compensation is not just an investor. We are participating in the Zambia's economic ecosystem by encouraging other companies to invest and also to obtain credit ratings. We promote a greater market transparency and discipline. We think this, in turn, would improve price discovery and the expansions of investable universe. When SMEs and private infrastructure projects are rated by a credible agency like your agency, it opens the door for core investments, securitization, blended finance models. All of those are crucial for Zambia's capital market growth. You may wish to note that the participation, especially in infrastructure projects, is very limited to only a few institutions. But if there is active participation of all market players, including credit agencies, we think this is going to assist the whole ecosystem in being able to open up the doors for co-investments with other players. The fourth one, which is facilitating strategic collaborations with ICRA, we also see an opportunity for direct collaboration. As an institutional investor, we can share insights on market risks, issuer behavior, and also participate in investor consultations and rating criteria reviews. You may wish to note that our institution recently signed an MOU with the ICRA ratings agency, and we are very hopeful that this deepened engagement is going to be able to assist us and make better investments with the risks that are tolerable for us. Further, the feedback that we will get through the interactions with the ICRA, we think that will help us improve the quality of the credit worthiness, and it will help us be able to know what actions to take and also the amounts to be able to push in specific investments. Strategic partnerships also for stronger market and economic growth. We think if we involve ourselves with rating agencies, such as the rating yourselves, that is going to spur a lot of growth. It will amplify our impact as a pension fund. They will offer a lens into a risk and also a framework for asset allocation and a platform to build more transparent and resilient financial assets. As Workers' Compensation, we look forward to closely working with ICRA and other stakeholders to unlock Zambia's capital markets sustainably, responsibly, and boldly. We think with the use of credit rating agencies, economic growth can be spurred, because in something that takes longer to be able to raise finances, it will no longer be that difficult to raise finances because the issuers who have some credit worthiness that has been somewhat approved by an independent party. That for us will be key because we'll be part of the institutions, of course, that will promote growth and be able to raise that needed capital faster and also be able to take development wherever it is needed. Thank you very much. I'll pause there for now.
Thank you. Thank you, Mr. Kakunta, for highlighting that vital strategic connection between credit ratings and also domestic investment. Your insights underscores that these ratings are, not just instruments for large established corporations, but they are also powerful tools for the entire economy. By providing an independent measure for financial health, credit ratings can, open doors for small and medium enterprises. It can also encourage entrepreneurship and enable investors to identify credible opportunities across diverse sectors. This in turn helps channel capital into industries that drive job creation, innovation, and also sustainable development in the market. Ultimately, the greater adoption of credit ratings strengthens the market confidence. It also widens participation in the financial ecosystem and definitely ensures that resources are allocated more efficiently to fuel Zambia's long-term economic growth. Once again, thank you, sir. Now we'll hear from the managing partner of AMG Global of Zambia, Dr. Friday Nyambe, who will speak about the strategic value and also benefits of credit ratings for businesses and institutions. Dr. Nyambe?
Thank you very much.
You're welcome, sir.
for this invitation now. And it gives us much pleasure to know that we are almost moving on time and that we have started on time. This is what we always fight for, to start on time, to have good time management. We should congratulate for that. I've already been introduced. I'm Friday Nyambe, and I would like to make a quick disclaimer, show that these are the views of the trustee on capital markets and not any other stakeholders. And I wish to repeat that so that it is clear that these views are for the trustees in the capital market and not any other stakeholders. We wish to thank you for offering us this opportunity. What I'll start with, I'll try and share my slides. And please, can you allow me to do that? Thank you.
Yes, please.
Right.
It's visible and clear, yes.
Oh, thank you very much. Just a minute. Oh, sorry, if this slide's gone. Sorry. I touched the wrong button.
It's all right.
Oh. No, just a minute. I'll whew. I don't know what has happened. Are they coming?
Yeah, we're seeing something in our screen with a heading of Unlocking Capital Markets Through Credibility and Confidence.
Now, I'm sorry, I cannot see my screen. I don't know what has happened. Let me just start all over again.
Okay.
Whew. Is it seen?
Yes, it's very visible to us, sir.
I hope I won't miss the pages now because what I've done, I've never done it before. Let me just...
Maybe you can end this current presentation that you're showing with us and just re-upload it.
Say that again? Okay, if you can see my screen, what are you seeing on the screen?
I think this is the front page of your presentation because it has the heading of Unlocking Capital Markets Through Credibility and Confidence.
Okay, just
but if you are having a technical issue on your end, maybe I can ask the next speaker to proceed, and then after her, then we can, do yours again.
Say that again.
If you're having a technical error on your end, sir, maybe I can ask the next speaker to proceed, and then you can follow after her.
Okay, that's fine. Yeah, thank you. Yes.
You're welcome.
Yeah,
All
I
right.
can do it. Yeah, thank you.
So for now, we'll move to technical dive, how credit ratings are conducted, what are the key methodologies, disclosures, and also the main drivers that influence ratings. So let's all please welcome our senior analyst from ICRA, Ms. Ravini Nayantara. Ravini?
Hello, am I audible?
Yes, Rubini. Thank you.
Thank you. Thank you, Ms. Bella. So let me start the presentation with sharing the screen. I hope my screen is visible.
Yes,
Let me reintroduce. Hi, thank you. So let me reintroduce myself again. I'm Ravini Bandara. I'm one senior analyst at ICRA. So today I will be taking you all through how a credit rating is conducted from the point of view of an analyst. So as you all know, at ICRA we conduct credit ratings. But how do we conduct it? So first and foremost, we do a thorough analysis on the business. So we take a holistic view and we do a comprehensive analysis. So how do we do this analysis? We divide our analysis into quantitative and qualitative factors. What is a quantitative analysis? These are the numerical factors of a business, whereas qualitative factors are the non-numerical factors. So when we are doing a qualitative analysis, first we analyze the internal environment of the business, and then we proceed to the external environment. What is the difference between these two environments? Here, it's all about the control of the business. In the internal environment, the business has control, whereas the external environment, the business does not have a control, but still this environment affects the company's performance and sustainability. Now, when we look at the internal environment, first we take a look at the business profile. Here, the analyst takes quite some time and studies on the business profile. When we study on business profile, we look at the timelines. Here, we first check at when was the business started. So this will give us an idea at which stage the company is operating. So this will also give us an idea, for example, if the company is in the growth stage of the business, they're prone to take more debt. So things like that we look into. And then we deep dive into the business model. So this is where we look at the products. These are the sources of revenue and the diversification of the products. Does the company give one product or one service, or there are multiple? And then we also look at the markets they operate in. Is it only local or is it like international as well? So, and the nature of business, is this like capital intensive business? Does it require a lot of funds? And we also look at factors like customers and suppliers. Is the company dependent on one or two customers or suppliers? So if so, like the bargaining power of the customers and suppliers are high. In addition to these factors, we also look at the competition of the business, like the peers, who are the other market players. So we will also, based on the available data, we will also do an analysis on them, and then we will get a good gauging of how and where our company starts. Our company means the company we do the analysis for. And other than that, we also look at some other factors like the inherent risks. For example, is the business cyclical in nature? Is it highly regulated? So these are few of the factors that we look into when we are doing the internal environment analysis. And another part of the internal environment is the management review. So why do we analyze the management? The management makes or breaks the company. They lead the company from the forefront. So here we take a look at the organizational structure, like the board of directors, the composition of it, the number of executive directors, non-executive directors, and then we look at the executive management, the CEO, the COO, and any other respective executive personnel. So here when we look at them, we look at the experience, their educational background, as well as any other achievements they have done. If they have done any successful restructuring or led any big projects, we also take that into account. And then depending on the size of the business, we also look into the corporate governance aspects. And now I will move into the external environment. So external environment, as I say, is the macroeconomic macro environmental analysis. Here the company has less control or sometimes no control. For example, the country in which they operate in and the industry in which they operate in. And when we do the analysis here, as analysts, one of the main things that we are considering is we do this analysis based on publicly available data. So the data sources we choose are very important. We have to make sure that we choose reliable sources. So we depend on the government release data or any other internationally accepted databases. So now when we go to the country analysis, what do we check? We check the political environment, the economical environment, the social environment, the technological environment, all that we take into account. I'll just give a few examples. For example, we check on the political environment because a lot of things depend on the political stability of the country. So if there are any elections upcoming or those factors also we take into account, and the economic side. So here we deep dive into the stats, and we see on these GDP data, GDP growth rates, and trade deficits or surplus, inflation rates, and balance of payments. All these technicalities we take into consideration here. And then moving on to the industry analysis, we do it in three parts. First, we check on the global industry, and then we check on the regional or the African industry, and then we check on the local or the domestic industry. For example, the copper industry in Zambia. So then we deep dive into the local data. And when doing the industry analysis, we also take into account the trends, the opportunities, as well as the threats. So this is how we do the qualitative analysis in a nutshell. And now I will proceed into the quantitative analysis. So as I said before, quantitative analysis is where we deal with the numbers. So here we do, basically, this is the financial analysis of the company. So what are the sources that we use here? We use the three statements, income statement, balance sheet, cash flow statement, and then we use bank statements, we use credit bureau reports, and we use forecast. So credit bureau reports and bank statements, they act as verification documents. For example, credit bureau reports tell us about the repayment capacity and the repayment history of the company as well as the shareholders. And bank statements as well, depending on the date of the rating, we will cross-verify the cash balances in the balance sheet with the bank statements. And we will also be able to see the credit turnover and the payment behaviors as well. And now let me tell you how we do this financial analysis or the quantitative analysis. I'll try to make it, I'll try to go less into the technicalities and try to tell it in much simple words. But I will have to use a bit of technical words, so please bear with me. So how is a financial analysis done? First, we take the three statements and we analyze it separately. And then we do the ratio analysis. So though we analyze this separately, it is kept in mind that these three statements are interconnected. And when we are analyzing, we need at least 3 to 5 years of audited financial data. And also, depending on the time of the rating, we will take interim data as well. That is the management accounts. But more weightage is given to the audited financials. And then when we're analyzing the financials, we do a horizontal analysis as well as a vertical analysis. What is a horizontal analysis? We look at the trends of the line items. For example, the revenue trend. Was the revenue increasing or was it volatile during the last 5 years? And vertical analysis. Vertical is we analyze the statements vertically. So ratio analysis is also part of it. And to tell, when we are doing ratio analysis, we do not only look at the ratios of the company, we take benchmarks into consideration as well, like the generally accepted benchmarks, because the factors depend from industry to industry. So that is a bit overall look on how we do it. And when we're analyzing, we give more attention to the latest years and we check the year-on-year changes of the latest years. If we say the latest rating which was done is in August 2025, and we have interim accounts until June, this year, June, and audited financials for 3 or 4 years until 2024. So our main analysis will be based on 2024 and 2023. And then we will take year-on-year changes and all. We will give more focus on the last years, but we will also analyze on the previous years as well. So what do we actually check in here? When it comes to the income statement, we check on the revenue. How is the revenue earned? We checked in the business model. And now we are talking about numbers here. So, and then we check the revenue, and then we check the cost behavior, like the variable cost with cost of sales and operating expenses. We check that. And afterwards, we check the profits as well, because everyone is concerned about profits. Like we check the gross profits, operating profits, net profits. We check the EBITDA as well. And then along with this, we will also check the margin ratios. What do we check here? Here we check for $1 of sales, how much of profits are earned. Like what is the gross profit, what is the operating profit, what is the net profit. We check these here. And then we also check the return ratios. How much of net income, how much of net profits are earned via assets? How much of net profits are earned via equity, return on equity, return on assets? And this is the first statement. And then, then we move on to the second statement, balance sheet. What do we check here? Simply saying, the balance sheet speaks about three things: assets, liabilities, and equity. Assets are the resources of the business. Liabilities are what the company owes. So here it can be interest bearing or non-interest bearing. Should I continue? Okay. So assets are interest bearing, and liabilities are assets are resources. And then we have the liabilities, which can be interest bearing or non-interest bearing. And then we have the equity. Equity talks about the owner's investment in the company, the vested interest. So there we check on the share capital and the retained earnings. And to tell a bit about the assets and liabilities, in the assets, the nature of assets we pay more attention to depend on the nature of the business. If it's a capital intensive business, such as manufacturing business, we would pay more attention to the non-current assets and its behaviors. If it's a trading business, we would pay more attention to current assets. For example, the trade receivables, how much of credit sales have not been collected by the year end. Or irrespective of the nature of the business, cash is king, so we pay a lot of attention to the cash balances as well. And in terms of liabilities, so liabilities, as I said before, can be interest bearing and non-interest bearing. In the balance sheet, one of the main important things we pay attention to is the debt. And considering this is a credit rating as well, we are very much concerned on the repayment capacity of the business. And then connected to this, we also check the leverage ratios. So what are leverage ratios? For example, we compare the debt and equity gearing ratio. How much of debt is in the business compared to the equity? For example, I talked about benchmarks before. For example, a generally accepted benchmark of debt to equity can be 1.5 times to 2. What does that mean? A company can have twice or 1.5 times of the value of their equity as debt. If the equity is 100, it's okay to have 200 or 150 times of debt. So these are generally accepted principles, but it depends on industry to industry, of course. And then other ratios such as debt ratio, equity ratio, which means how much of my assets are funded via debt, how much of my assets are funded via debt, and how much of my assets are funded via equity. So in the balance sheet, we also check on the liquidity, how this also talks on the repayment capacity of the business. In terms of any headwinds facing the business, are they able to sustain? Do they have enough cash, or are they able to quickly make the assets into cash? For example, we check ratios such as quick ratio, current ratio. So for example, it talks on how much of current assets are there in terms of current liabilities, that is the short-term liabilities. So things like that we check. And the cash flow statement, this is the other key statement. Cash is working. So in the cash flow statement, we can see the cash movement within the year, and more importantly, we are able to see whether the business is profitable from its operations. So whether the business is able to generate cash from its operations. If it's not, the sustainability will be less. So these are little factors that we consider. And also we will check on the working capital. Working capital means that amount of cash which is required by the company to operate in the short term. So here, for example, we check whether the company has been able to collect their receivables from last year to this year. That means have they been able to turn around their credit sales into cash? And have they paid their suppliers, or have they utilized their supplier relationships and have not paid? And have they been able to turn around or sell off their inventory? And have they been the cash movements related to this, we are able to analyze. And furthermore, we are also able to see whether the companies have reinvested the money back to the business in the form of capital expenditure, or they have given out money to their shareholders in the form of dividends, which is also needed. So things like this we check in our analysis. And then, as I said before, these three statements are interconnected. I will tell you some technical things on how these are interconnected. For example, from the income statement, we check the revenue and the profits. So everyone is concerned about profits. So this profit, what happens to this profit, we can see in the balance sheet. Are they going to reinvest it into the business? Then we can see it in the retained earnings. Or are they going to pay it as dividends? Then we can see it in the cash flow statement. And then finance cost. Finance costs are there in the income statement, and we can see the movement of debt and finance cost together. Like debt is in the balance sheet. Is the movement of finance cost aligning with the movement of debt? If so, great. If not, why? For example, is the debt increasing little, but finance costs are increasing a lot? So that might be with the increasing sales, the company might be resorting to trade instruments, and there might be high interest. So things like that we are able to check when we analyze. And a few other ratios that we check, such as the working capital ratios, average receivables. So we check the trade receivables along with the cost of sales, or debt to EBITDA, which is one of the ratios which are checked by the investors. How much of debt is there in the company compared to the EBITDA? So factors like that we will be checking. And operating cash margin, how much of operating cash the company is able to generate per $1 of sales, or per one kwacha of sales. So these are few of the things that we check in our three statements. And to conclude our analysis, we also do forecasting. But however, this depends on the reliability of the forecast given by the client. How do we judge it? It has to be reasonable, as well as it has to come with proper justification. Like if I say I will increase my revenue by 20% next year, there should be a plan. So things like that we consider. So this is how we do a financial analysis, the quantitative analysis, as well as the qualitative analysis. I hope I didn't bore you all with the technicalities, but yeah. So this is it from my end. Thank you so much.
Thank you, Ravini, for that very detailed presentation. And thank you for, taking us through the technical side of ratings in such a very clear and structured manner as well. Your explanation of the methodologies, disclosures, and key rating drivers in evaluable of market participants who want to move beyond simply reading rating to truly understanding what it really means. As you've shown, this knowledge empowers businesses, investors, and policymakers to interpret interpret the rating report accurately, anticipate potential changes, and also proactively address the factors that influence the credit rating standing. It also encourages greater transparency, as issuers who understand the process can align their governance, risk management, and financial strategies to maintain or, improve their ratings. So by demystifying the technical aspects, you've helped bridge the gap between complex analytic frameworks and also practical decision making. So equipping this, of course, equipping the stakeholders to use credit ratings not just an important reporting outcome, but as a strategic tool for growth and resilience and market credibility. Thanks again.
Thank you so much.
Let's go back with Dr. Friday Nyambe. I believe he's ready to proceed with his presentation. Again, he will be speaking about the strategic value and benefits of credit ratings for businesses and institutions.
Thank you very much.
You're welcome, sir.
Technology, things happened, but we managed to sort it out with ICSR.
Thank
Please,
you.
can we have the first screen?
Yes.
Just
It's
go
visible
to
now.
the.
Yes.
Thank you. Yes, as I was saying that we are very grateful for what you have done, and this is what we've been looking for in the capital market. And also want to once again, since there was a cut, just wanted to repeat our quick disclaimer that these are the views of the trustee on capital markets and not on any other stakeholders. These are the views of the trustee and not any other stakeholders. Please move on to the next one. The next slide. Why does Zambia need a credit bureau for the capital market? Is it necessary? One of the reasons I think they've been said by the other speakers, but I just want to re-emphasize of the importance of this topic that we are dealing with. A credit bureau collects all the information about borrowers. You will know exactly where they stand. And we thank the Ministry of Finance. They came out and told us that there was a credit rating on the country of Zambia. If that can be done for a country, this must be seen also in institutions where money is moving from one sector to the other. Institutions must be sort of rated and create some confidence in the investment. Second point, in this capital markets, particularly for debt securities, access to reliable credit data helps access issuer risk. If you've seen that, and you know where you are putting your money, and you know that it will be taken care of, there must be a credit rating. It's very important in the capital markets. Yes, we could have these maybe in our books, in our statutes, but the implementation, that needs to be moved upon as quickly as possible. This also creates improved transparency. You know where you're putting your money. Not you are told this bank or this institution has gone under and you are not sure where to get your money. But if you know exactly from the start to where they are, then you are in a better position. And also if it's risk-based pricing, like what one of the presenters mentioned, that the bond depends on what the money is going. When it is risky, the return is higher. So we are knowing the pricing, how to price it out. Inclusive lending and market growth. The market will grow once we've got this in place. It will strengthen the capital market. Reduction in information asymmetry. Shifts lending decisions from verbal, not where I've given a decision by a verbal, but at least you've got something that you can rely upon. Please, let's move on to the next slide. I know we have run out of time. Next slide. Javel, maybe there's somebody who's doing it for me. Oh yeah. Credit ratings matter in Zambia's emerging capital market. Well, our market is emerging, and so far, good things have come up. Oh, what's happening now?
Yes, it's visible with us.
Sorry, I don't know what they are doing. The people are doing it for me. What is credit? So we move on to what is credit rating? Credit rating is an independent assessment of corporation or government's ability to repay a debt. They were seen in our country was. Can you get me, Javel?
Yes, yes.
Okay, although I cannot see any slides now. Yeah, there we are. A credit rating basically indicates the likelihood that an issuer will default on a loan or other debt instrument due to bankruptcy. So that's why we can see that before you even give out your money, there must be a credit rating. I've retired, I've got all the money that I've earned, my retirement benefits, I must invest them in a place which I know that I'll be able to get my money back. Or you've got an investment, you've got money from people, invest it where you know that a return will be good for you. Investors use credit ratings to determine the risk of buying bonds and other debts from these groups. So in every way you buy, you must make sure that things are okay, you get your returns, there will be no problems at the end of the day or end of the year. Whatever you invested, you get it. Assigned by licensed credit rating agencies. We've just said it, that in Zambia, we've only got, at least from the capital market, 2 credit agencies. Yes, if they are able to perform the job, that is a good pleasure. And we want to see this happening. We as a trustees, we are always taking investors from all different sectors of the economy, and they must get their money back. And we've written to people who are running these schemes that they must get some credit rating. And this thing, we need to see it taking place as soon as possible. Current landscape in Zambia. Zambia's capital market is underdeveloped compared to regional peers in terms of this credit rating. Credit rating open access to bonds, pension fund investments, cross-border financing. So once this is done, it sort of strengthens the market. The capital market is one of the biggest things that we need in the country. A strong capital market will make sure that funds are available for economic development. But once we don't have a weak one, people will not be able, well, some people don't want to go to the financial institutions to get a loan because of the rates, the interest rates and so forth. But in a capital market, things are quite easy. May we go to the next slide? Yes. The next slide. No. Yes, strategic benefits, access to alternative capital. There are people who cannot qualify to go into big local region. Alternative capital market refers to broad category of investors, of investments that fall outside traditional asset classes like stocks, bonds, cash. They deal in private equity, real estate, commodities like gold, agriculture. So there's an alternative market. And I think in Zambia, this is a market we need to develop as quickly as possible as well. We've got a proper capital market, but an alternative market where people don't have funds, they don't have what is required to qualify to enter into a stock exchange. They should be able to go and invest somewhere. And for that reason, there must be credit rating. Credit rating enables eligibility for corporate bond issue as well. Once you know that it's alternative market, there it is. And it's well rated. The people are players, they are well rated, they're outstanding. Yes, finance will move there. Rated instruments increase confidence of institutional investors in an alternative market is rated. A strong institution will invest in it there. They know that they'll get what they're expecting from what they've put in there. Helps to broaden market access of issuers. So issuers will be going there and they'll be able to get what is required. And cash or funding is provided for the economic development of the country. You know, we can move on to the next slide because time is not with us. The strategic value of credit ratings. Why is it important? One is transparency. It enhances issuer disclosure standards. The issuer will put in the standard, make sure that the things are correct and they are supportive of what they are saying. Not issue out this and yet you do not meet the requirements. For instance, you said prospectus, but you are doing something different. But that's why we're saying, credit rating, they increase transparency. And this also encourages market discipline. Once information is available, everybody will want to move in there. Comparability, benchmarks risks across sectors and instruments. You know, this is very important if we've got a credit rating. And well, we're very thankful and we're very glad that we've got at least two. But we want to see these now being effected in a way that it creates confidence in the investors. The credit values also influences the costing, the impacts, yields, and cost of capital, the pricing influence. Once you've got that information, the pricing moves in a way that is satisfying to the investors. Move on to the next slide. Credit ratings and institutional credibility signals financial discipline and the governance strength, because corporate governance is very important. And once we've got credit rating, then we know that that institution, that issuer, or the way we are putting our investment, there's corporate governance. And we know what corporate governance requires, that you do things according to what is on paper. Facilitates access to regional, international capital. So once we are we've got this credit rating, funds will flow into the country and to be very good for us. Investments will come. And this is our time to do this. We should not wait. This is the time we have. It enhances reputation with the banks, financial investments, pension funds, and other investors. They will come in. Once we have this, please, this is a thing that we need to fight for. Well, it's already there, but the effectiveness of it, it's not yet known by many people, but it's already there. But once this is there, we'll attract a lot of finance that is required for development. Next slide, please. Boosting investor confidence. Well, I've already mentioned that. There's no need to go back to those. Please, you can move on. I'm just looking at the timing. This one, unlocking funding opportunities, you know, lower perceived risk, lower cost of borrowing. You know, you want to get some money. Institutions want to get money to develop, buy machinery, to put up a lot of things, development, whether it be mining, agriculture, and so forth. They issue those bonds. And once they are rated, surely, even our people who do not know a lot will go in there and invest, and funds will be made available. Development comes. This is our time. We should leave a good history for the next generation. And this is our time to do it. We need to make sure that when we're investing, the returns will come. Yes, please, let's move on to the next slide. Advantage of a credit bureau in Zambia. Well, I've mentioned some of these things. Constant evaluation criteria, standard lending terms across diverse institutions. Incentives, better borrower behavior. Timely payments improve the score, especially when there's this credit rating and payments are made when they are due. Not where institutions that instead of paying back the investors, you have to go through a process of going to court and left and right. But if you can get your money there, then things will make this country strong, and it will make, we'll see a lot of development that we had expected. Capital markets. Yes, a capital market, that is one source of funding where we can get funds. And for that to be effective, yes, we thank SEC what they are doing. They're doing a terrible, good job, an excellent job. But we need to assist them. Make sure that investors are putting money where they know they'll get their returns. Let's move, please. Obviously, there are disadvantages as well. At times, you might not have complete data. You might have incomplete data. The prospectus is the same thing, something different. And also there are errors and a number of things that are not correct if you do not have a credit rating. So we need institutions of credit rating which are upright, who are true. Those who, when you say this, the credit rating was done by this company or by this firm, whoever it is, you know that a good quality job was done. With thanking the last speaker, she explained how the methodology of doing it. These must be seen that they're being done in a proper way. There is quality work. What is coming out creates confidence, and not that they've done the rating, but then the institution fails. That will sort of destroy everything. So we need to start with the rating agencies who are strong, who will provide reliable information so that the investors, they can get their money at the end of the time. There are many other institutions, or maybe I don't know, other countries, who haven't been unable to get their investments because the institutions have gone under. So we need to make sure that the credit rating agencies are of good standing quality, which means we must do a lot of research upon them, due diligence to find out whether they're doing a good job. Okay, maybe let's see, time is running out. Next slide. Maybe let's move on to the next slide. This, I think we've spoke about it. Lucy, well, this one, I've also mentioned it. We can move to the next slide. We've dealt with it. The limited pool of rated entities dampens market benchmarking. That one was spoken over it. Time is not with us. Please, can we move on to the next one? Strategic benefits, these I've also mentioned them. I think let's go. People who want, they can read that on their own. These are still, well, strategic benefits, enhanced reputation, basically published ratings act as a third-party validation in a low transparent environment. I spoke about that. They must be of good outstanding. Critical for PPP contracts. Yes, we can move up. Strategic ways, please, well, let's move to the next. We can read, strategic benefit, lower cost capital. There we are. Some of the things I've already mentioned them before even the slides came in. I'm not in control of the slides, but thank you very much. Please go ahead. The next slide. Challenges and opportunities in Zambia. Key challenges well, maybe I'll get to my conclusion. Let's go to the conclusion, I'm sorry. Credit ratings as instruments of progress. That's what should be in our mind all the time. Credit rating is an instrument of progress. Without credit rating, we're in trouble. More than funding tools, they drive accountability, discipline, and growth. Because if there's something wrong, the credit rating agents will come and say, this one is not a reliable person. Credit rating agencies in Zambia must offer the local infrastructure to support market growth. We need to see that. Conclusion. Credit ratings is, okay, I meant to say that one. Call to action, champion wider credit rating adoption. Please, let's move on to the next one. I think it's maybe the last one, action. The next slide, recommendations. These are the recommendations. Let's go to the recommendations. We must expand submission on board, telco, digital lenders, MFIFIs, utilities into the credit rating bureau ecosystem. Educate consumers, promote knowledge of credit rights, how to access dispute reputes, regulate compliance. BOS and SEC should monitor data completeness and quality, and with very thankful that SEC, they've already done that. They're doing that so far. According to the presenter, Gertrude, she told that this is what they are doing. They want to see quality. Let's encourage issuance of diverse capital instruments, e.g. corporate bonds, green bonds, aligned to credit data. We are very, SEC, what they have done, green bonds, they are sort of the things in our market, in our capital market, the green bonds. Thank you, SEC. I think it's through your master plan. Strengthen data governance, enforce private safeguards and fair use principles. Thank you. Let's move on to the next slide. I think we are almost, credit ratings are not just compliance tools, they are analysts for capital access. That's what we should realize. They are analysts for capital access, market transparency, investor confidence, regional integration. With people, our neighbors here, whom we can integrate with once there's proper credit rating. So let's remember these four: capital access, market transparency, investor confidence, regional integration. Africa cannot deepen capital markets without reliable credit benchmarks. We cannot go very far without credit ratings in Africa. The next slide, please. I think that's the end of it. Madam Javel, thank you very much for the opportunity you've given me. I wish I could have said a lot, but time is not with us. Thank you.
Thank you so much, Dr. Nyambe, for those insightful and very forward-looking points that you have shared with us. Your discussion on the strategic value of credit ratings really highlights that these assessments go far beyond compliance and that, they are very essential tools for long-term business planning as well as sustainable growth by providing an objective measure of financial credibility to credit ratings can unlock access to a wider range of financing options, both locally and internationally, allowing businesses to expand with confidence as well. As you've rightly pointed out, they also play a critical role in improving stakeholders' engagement as transparency builds trust among investors, partners, even for regulators, and as well as the customers. Furthermore, a strong credit profile helps institutions weather economic uncertainty, seize emerging opportunities, and position themselves competitively in an increasingly interconnected global market. Ultimately, the integration of credit ratings into corporate strategy is not just about meeting today's objectives, but also about building resilience, adaptability, and also solid foundation for the future. Again, thank you so much for that.
Thank you very much.
You're welcome. Now we turn to a real-world example, like a case study from Africa illustrating how credit ratings improve access to finance. So please welcome with us the country head manager of XSML Capital, Mr. Ika Bali.
Thank you very much, Jamila.
You're welcome.
Yeah, thanks. Good afternoon, everyone. I'm Ekabali, Associate Partner and Country Manager at XSML Capital. So I'm pleased to be here today to discuss the vital element in unlocking finance for companies operating in frontier markets. I'm trying to really emphasize the word frontier market because that's where we are actually operating from. And this financial tool or element that we are talking about is actually credit rating. So at XSML Capital, we have more than 15 years of experience supporting SMEs businesses in these markets, which often face unique challenges in accessing capital. So today, we'll try to explore how credit rating serve as a critical tool for investors and borrowers alike. And I will try to illustrate this concept through one or two cases or two case studies, one from the DRC, another one from Uganda. But I'll have a little bit more flavor into the DRC context. I'll try to make it very short because I've been working in DRC for the longest, actually, for a little bit more than 7 years in DRC. My goal is actually to try to share an insight and practical strategy that can help companies improve their rating, thereby gaining a better access to funding that fuel growth and development. I will divide the short discussion in 5 points. So the first one will be it will be like understanding rating in frontier market. The second will be a very short study, the short case study that I've prepared. And the note in the most market I've like the mostly in the DRC, but in the market I've mostly operated in. But I would like you guys to note that in DRC there is no credit rating agencies. Just for fact. So bear with me, and then you might understand from the case studies how we do things. The third point will be about rating and access to finance. Fourth point, challenges and lesson learned. The fifth one will be just the implication for investors and borrowers, and maybe I'll conclude afterwards. So, in the first point, how are rating assessed in the frontier market? I think that Ms. Ravini has gave a full picture of how the how the rating is actually assessed. So I'll try really not to go too deep into that. I think that she knows better than I do because I'm a financier and investment analyst as well. So in that perspective, we also do our own assessment, and that leads to an investment approval or not, basically. So it can also be considered as a form of rating businesses when you do your investment analysis. So we do internally consider that as a form of rating because if it's approved, then your rating must have been good enough. The way you have rated the business to be good enough for the committee to actually approve the business so that they can access the financing. So unlike stable markets where data is abundant and the environment predictable, so the frontier market itself poses significant challenges. You have the rating are based on several criteria, including transparency. I think everybody mentioned that. Governance, Mrs. Ravi mentioned that. Financial stability and country risk factors. Well, I will not start to enumerate all the factors, but understanding the country risk factors, of course, there is one which can be political, and there is also the aspect that can be economical aspect or systemic factors as well. But given the data gaps, market volatility, and political risk, obtaining a reliable rating can be very difficult. Often, international agencies like the S&P, Moody's, already rely on limited information as well. Similarly to the local rating agencies in Africa, I think Mrs. Ravi mentioned it, that they are still also working on developing their own methodologies. And this is something which is evolving every time. But those factors actually create disparities and gaps in how companies are perceived and financed, especially in the SMEs ecosystem, because that's very important, because that's where Africa is actually strong at, SMEs investment, and the SME ecosystem in Africa is actually the strongest. Now, let me walk you through in a sort of a real world example. So we supported a mid-sized mining supplier in the DRC, focused on water and pipe solutions. So despite the challenging local environment and the absence of formal rating agencies, so we conducted an internal assessment ourselves to actually find a way to assign to it a form of rating, which can enable us to actually be able to provide the financing, which is in debt form, to the company. So the terms that came out from those assessments actually suited the country's context and was also a factor to associate the risk and the return that actually we were actually looking for. But this rating was based on the financial health, the governance, and the strategic importance of the services to the growing mining sector. That was very important. That was very critical. So this case actually demonstrates how a strong internal rating can unlock vital funding, and then can also support growth and the expansion of the business. So, like I said, it might seem unusual for a private debt fund to develop its own rating, but as I mentioned, rating depends on various criteria, which can lead to disparity. Our internal assessment serves as an indicator of a company's ability to secure finance. So another case study from Uganda. So we did the same kind of assessment we had done actually in DRC without consulting a credit rating agency. Yet there are credit rating agencies actually in Kampala versus DRC, which they don't have. So actually this resulted into a bad investment. We actually completely failed in that investment due to an assessment that was based on tempered information provided by the promoter. So sometimes in Africa, you might get to the point where you have information, however, the information may be tempered, but they are not actually very accurate. And using those type of information, especially in our businesses, leads to bad decision making. And that was our case actually in Kampala. But then only after engaging with one of the established credit agency, did we discover the entity's actual credit worthiness? It was actually low. So we ended up realizing that, well, maybe our experience in DRC was not matching. We cannot just do a copy paste in Uganda or in other countries. Maybe we need to learn what's going on in the market in which you're trying to implement a different strategy to see what people are doing, and then trying to see if that fits the strategy that you already had built in another market. So we realized that actually going through credit agencies in Uganda was actually very important for us at that moment, because the culture differed completely compared to DRC, where in DRC everything was based on trust, and you can just ask around the market to actually know. You can do a sort of an assessment of a promoter, of a person around the market by or in the ecosystem by asking peer to peer, what do you think about X? And Y will tell you what he thinks about X. And then you can have an opinion, an honest opinion. But in Uganda, it's a bit a more different approach. People will keep to themselves, not really sharing completely their thoughts about a person, not to come out as a bad person. But then gladly there are different credit agencies that actually helped us to continue to be able to do some assessment, a deeper assessment on our different potential investee companies. So on the fourth, now let's move on to the fourth point. We're looking at the rating and access to finance. So what does this mean for access to finance? What it means actually? What does credit rating mean for access to finance? So well, in a short form, I'll say that essentially a good rating can significantly lower borrowing costs and expand financing options. In the opposite way, a lower rating can limit access and actually increase your costs, making it harder to actually grow and be and get to where the business is supposed to. It also impacts the negotiation. I've seen that quite a lot. Lenders and investors uses rating as a key indicator of risk and credibility. So me, as I sit here as an investor, obviously looking at the country risk, looking at the country rating, and and everything else that comes around the aspect of the country in that rating aspect, I can easily ask for a higher interest rate because I am taking risk to invest not only in DRC or in Zambia or in Uganda, but I'm also taking risk to invest into an SME and giving a form of an investment which is not very much present or easily accessible. So then all that gives me a certain form of age in a negotiation part. So that can actually be used in that form. However, it's also stand the same for a company which has a higher rating, giving the company the leverage and confidence in their growth plan, in the form of in the plan to grow. Um, and the opposite happen once you have a lower rating actually, because then you have you have you have a lot of you need to address a lot of strategic aspects for you to get those barriers created by lower rating. So that's about a bit the rating and the access to finance. So in the fifth point, the challenges and the different lessons learned. So I'd say, of course, achieving and improving rating isn't straightforward. Challenges include incomplete data, political instability, which I've mentioned, or weak local institutions that make it hard to paint a full picture. But we have learned that engaging with rating agencies proactively, actually, very much proactively, that's very important word, proactively. So also improving transparency and strengthening governance are essential steps. So I think companies or entities mostly operating in the SME sectors, because I've heard everyone talking about loose or the capital market as loose bonds and the likes. But we tend to forget that the ecosystem is not only built around those instruments. The ecosystem as well is built around the fact that you have capital coming from outside flowing in to be invested in mostly SMEs or real businesses, like I like to call them, to actually grow and have a real impact into the society. So those businesses really need to try their best, to engage, right, with those agencies proactively, because you don't want to be asked by an investor, oh, have you ever done that before? So it's a matter of being very much proactive to fit the script of the current situation, and also being very much transparent and really focusing on strengthening the government, the governance. Those companies that actually focus on financial discipline as well and clear communication, we also seen that they see better rating over time, which opens up more funding opportunity. So that's a bit on the challenges and the different lessons that I think that I've learned so far. But what does it mean for the implication for investors and borrowers? So I believe that for investors and companies, rating matters profoundly. A higher rating reduces borrowing costs and enhance reputation, making a company more attractive in the market. So for borrowers, it's about positioning themselves as credible, well-managed entity capable of serving debts. So that's how we actually looking at them. That's how we see the borrowers in the sense. So um, my advice my advice to them will be to, let's say, prioritize transparency, good governance once more, and strategic engaging to build a sustainable, credible margin, no, credible rating. I think those are very key, like I mentioned on the different challenges, because they need to really focus on being transparent, having good governance, and really continue and engaging the credit rating agencies as much as possible. And this is very, very important for frontier market entities, and that leads, and it's a key factor for sustainable growth, I believe. So I think I've pointed out those five points, but there is maybe a conclusion part that I can add here is that well, I believe that today's discussion highlights on the credit rating are quite just to understand that the credit rating is actually it's a powerful tool, particularly in frontier markets to unlock financing and foster growth. So the case studies in DRC and Uganda, that gives giving the right focus on understanding that transparency and the right governance are very important because one had the transparency and had the good governance. We did our internal assessment. The other one didn't have transparency, and we actually failed not to get the right outcome out of the company. So this can have a significant um, can let's say significantly any company that actually has those items of transparency and good governance significantly improve the rating and access to better funding to better funding. Not only the funding part, but also the terms of the funding, of the financing. Um, as I believe also as the landscape evolves, transparency and regulations will play increasingly an important role. So my final message today will be effective rating strategy are vital for sustainable development and attracting investment in frontier economy. So thank you for your attention, and I look forward to connecting with some, if not most of you guys.
Thank you, Mr. Bali, for sharing that very practical and also highly relevant case study from Africa. Your examples illustrates in real terms how credit ratings, when applied effectively, can go beyond being a compliance requirement to becoming a catalyst for tangible growth. It explains that by improving transparency, also signaling credit worthiness, and building investor trust, credit ratings can open doors to new financing channels that might otherwise remain inaccessible, particularly for businesses operating in challenging or undeveloped markets. As your case study shows, these benefits extend for, far beyond large corporations. They can empower SMEs, enable infrastructure projects as well, and unlock cross-border investment flows. Ultimately, this creates a multiplier effect as well, which is strengthening the businesses itself, generating jobs, boosting local supply chains, and contributing it to overall economic resilience. So, in overall, your insights remind us that the right combination of strong credit ratings and strategic financial planning can turn potential into performance even in the most competitive environments. Once again, thank you so much for it.
Thank you again.
Yep, a heartfelt thank you to all our distinguished speakers for this depth and clarity you brought to for today's sessions or discussion. Each of you has shared perspectives that not only expand our understanding about credit ratings, but also highlight that their practical impact on Zambia's capital market development, investor confidence, and also long-term economic growth. Your contributions have provided our audience with valuable knowledge, actionable insights, and also real-world examples that bridge theory and also practices. So we'll now open the floor for questions, which will be held by Mr. Mohit Chadha, our ICRA's Global Director. As mentioned in the beginning of our session, we will be prioritizing those questions that has been posted on our Q&A box. Then we will entertain further questions during the interactive session as well. And of course, we will direct each questions to all relevant speakers. So we encourage everyone. I know we're running out of time, but we still encourage everyone or all participants to take advantage of this opportunity to engage with our experts. Mohit?
Thank you so much, Vella. Right, I'll try to just read out the questions for the speakers to look at it, and I'll just start the first one with Ravini. So there's a question regards to the frontier market ratings face severe data limitations and structural limitations. How do you adjust your models to avoid systematic bias when local accounting standards, limited disclosure, and frequent policy shocks make historical data unreliable? Would you like to take up that?
Yes. So thank you, Mr. Mohit. Yes. So as per my understanding, this question is talking on the data limitations and structural issues with the countries being developing countries. And yeah, it's a good question. But there are some areas which I do not agree to, such as this historical data not being reliable and frequent policy shocks. So we do not take a lot of historical data. Maximum is 5 years. And we also take the management accounts, like I said in my example, when it's about 6 months later after the year end, we definitely require management accounts and we pay attention to the latest financial data. So this is also mitigant. And I think frequent policy shocks, as per my understanding, the policy changes take some time to come into action. And even before the policies are introduced, it's told to the market. So there's market awareness. And these policy changes will be reflected at least 1-2 years. So it will take some time for it to be fully implemented. And now there are factors I agree also. Yes, there are data limitations as well as there are discrepancies in reporting as well. So for these, the mitigants we strictly take audited financials 3 to 5 years. Management accounts also, we have strict procedures. We ask it to be signed and given justifications as well. And so to emphasize on it, ICRA is based locally. So we have local officers and we have local analysts, we have local directors, and we have local committee members as well. So when doing ratings, the local analysts also do, like they do majority of the work. So they do have a good understanding on the markets or any changes which happens. And then on limited disclosures, we also talk to the client. We send them queries, we get into discussions with them, but this will be properly non-biased. We give them a chance to explain themselves. And if we find the data is not enough, we ask. And just because they tell, we do not believe it. We also, if it makes sense and if it's justifiable, yes, we take into account. And when going to the question on the models, yes, we have models, but these are not fixed or these are not automated. These ratings are not automated. Like real qualified analyst works hands-on and put hours into this. So yes, the models are there, but and then we exercise our judgment, professional judgment. And it's just not one analyst. Let's say one analyst is working on the case. There's another reviewer for him, as well as he has to justify in 2 committees, internal committee and external committee, where the rating is decided diplomatically. So all those mitigants are there to face the little challenges. So I hope I answered the question.
You did. Thank you so much. There's one question for Gertrude from SEC. It's a long question, but I'll make it in a simple way. Like, was there any instance in the recent years where SEC was able to identify if rating agencies having any kind of an issues regards to their transparency, accountability? It can be domestic or foreign rating agency that is operating in Zambia. Is she with us?
Miss Gertrude, if you're trying to speak, you're actually on mute.
Oh, she's there.
Hi, I think she must have responded in the chat.
Okay,
I
sure.
think yeah, because I've seen also, even also from my end, I mean,
Yes.
someone who asked, Jeff had asked about the LUCE in terms of what we are doing with regards
Sure.
to making sure they are SASO did with exactly.
Okay, we just go to last two questions and then we can go ahead with that. Do you think African country stock markets are well positioned to push economic growth? Is it possible for African countries to formulate a uniform stock market regulatory framework? I think this one I'll let you also come in, Mr. Crispin. Like, in your point of view, every country in Africa should be having their unique securities exchange or stock markets, or it should be formulated as one for African? That is a question from one of the participants.
Well, I think at the moment, obviously there's still a lot of collaborations in terms of there's exchanges in Africa working together. In Southern Africa, there's one, organization. There's also another one for the whole Africa. So obviously there are a lot of reforms that are happening also in that space, just to try and make sure that we then kind of align, in terms of the rules, the listing rules, for example, and basically how everything is. Because we're always also doing benchmarking just to make sure that we are always aligned, best practice. But in terms of having one big exchange, it's a good idea. It's a very good idea. But obviously, a number of things has to change. The reforms, because remember, every jurisdiction, obviously, there are rules, and obviously there's an exchange, there's a security, there's a commission that obviously oversees the capital markets based on the jurisdictions. So I think it's something that can be very interesting, but obviously a number of reforms have to be done. Thanks so much.
Thank you, sir. There's one question which I will just answer, then we can go to the end remarks. So there's one question that is related to if credit rating can also help or they can do ratings on startup companies. I think the analyst, Ms. Ravini, also answered on that one, that we need at least 3 to 5 years of financials. So the credit rating needs to have some trends, needs to have a lot of factors. So credit assessment and credit ratings are not two conjoined factors. And the credit assessment is part of the rating process. But doing it for the startups where the financials and a lot of information is not available, accurate credit ratings cannot be conducted on that, and that's why we I can say for majority of the credit ratings that exist in the world that they will not be taking part on the startups company for doing the ratings on them. There are a lot of credit assessment and the risk mitigation reports that can be conducted, or the project analysis reports that also rating agencies participate in, but not a rating assignments cannot be conducted on them. Right?
Yeah, I'd like to
Yes,
put a little point into that because
sure.
I understand this question in a way that well, we're speaking of rating businesses. Are we speaking of rating business on its form? Obviously, I get what he's saying, but I understand as well your point, and Ravi was saying as well. You need 5 years of data and all that, but in a startup per se, the first question is what represents a startup, or what is the lead in a startup? We, as an investor, the lead is actually the person behind the business, basically. So I think you can as an individual, you can have a credit rating as well as an individual. So that can be used as a form of credit rating for startup to actually rate you as a person on a credit rating. But that is now a question to Ravi will be I don't know if in all these credit agencies currently have we looked at individual credit rating so far, because that's where I was trying to look at. That's what I was saying. There is a gap in terms of data. The data we're speaking of, it's not only factors of companies having having the data as financial governance and the likes, but the data are global in terms of the personal data for yourself or myself. When can I get a credit card? Am I a good repayer as a person? We have in Zambia here mobile money. People actually get personal lending in mobile money very quickly here and there. Are those data valuable to be able to start as well doing a sort of a credit rating for personal people? Then we can speak of rating for startups. So to Ravi, the question: is there something? Is it something that has been looked at already in that sense? Already.
Yes, sir. Just to answer on that also, so risk scoring and the credit scoring models are available in Zambia as well. Like we are also having a system which we call it ICRA scorecard, where we are doing the risk scoring on the individuals as well, and you can say on the startups as well. But that's what I was just saying. Like rating assignments are not available, but risk mitigation or risk scorings, credit scorings, credit scorings, the CRBs are already there in the market and regulated by Bank of Zambia also. And the credit scoring models we have in ICRA scorecard that we provide to the MFI and the banking institutions also. So this thing is, but the rating assignment part, I was just saying, and I completely agree with you. These things are very important on the individual level also. Individual scorings, individual data is very important. Even we agree with that. Like when we are doing rating assignments, we also look at the CRB reports on the shareholders as well, if it's a private entity. And we also, for the companies also, we try to take their CRB scores to understand their payment behavior as well, because this information actually helps to see how they're currently doing as well, and that helps in the rating assignments also. So these are just small factors actually which are also part of the rating assignments. And for the startups, we have the more model of the risk scoring, but as a rating assignments, it's something that needs more data that initially startups do not have in hand. Right. So Bella, I'll bring it back to you.
Thank you.
So you can come to.
Yeah, thank you again, Mohit, for that. I believe today's sessions is truly insightful and very informative to all of us. As we conclude, I would like to sincerely thank all our distinguished speakers, participants, and also organizers for making today's session as a success. Key takeaways from today's discussion highlights that credit ratings are not just a compliance tool, but they are also a catalyst for investor trust, capital market growth, and sustainable economic development. So I would like to invite Mr. Trevor Hambayi, one of the well-known and reputable economists, to deliver the official closing remarks for us. Mr. Hambayi?
Thank you very much, Javela.
You're welcome.
Thank you for having conducted the proceedings of this webinar so well. I think you have done a great job. But on behalf of ICRA Zambia, a huge thank you to everyone involved in making this meeting possible. To the organizers, thank you for your meticulous planning and execution. To our sponsors, your support is invaluable, and we are grateful for your trust in us. And all the participants, your engagement and insights have enriched our discussion. We are honored to have had all of you. In conclusion, I believe that our credit rating agency is a game changer for the African landscape. By providing accurate and reliable credit ratings, we can help businesses access financing, build credibility, and grow their operations. We invite all the businesses, financial institutions, and investors to partner with ICRA and take advantage of their expertise and services. Together, we can build a more robust and inclusive financial system that supports the growth and development of Africa's economy. Thank you very much for everybody who has attended this. Back to you, Javela.
Thank you. Thank you, Mr. Hambai, for those thoughtful and inspiring closing reflections. Your words have perfectly tied together the key themes of today's discussion and reminded us of the opportunities that lie ahead in strengthening Zambia's capital markets. So, thank you once again for joining us. We look forward to continuing the conversation on building a stronger, more transparent, and investor friendly capital market ecosystem in Zambia. Have a wonderful evening, everyone. Bye for now.
Thank you. You too.
Thank you.
Bye-bye.
Thank you so
Bye.
much. Bye-bye.
Thank you. Bye.